Here's a scary thought. The person most likely to steal from a business is usually someone the boss completely trusts. In this video, we crack open how fraud actually happens and the surprisingly simple controls that stop it cold. This is fraud and internal control. Let's get into it. So, what is fraud really? Fraud is a dishonest act by an employee that helps themselves at the company's expense. That's it, and it shows up everywhere. Take a small print shop where the bookkeeper quietly rerouted $80,000 of vendor payments into her own account, or a warehouse clerk trusted for 15 years who shipped himself $60,000 of merchandise, one box at a time, or a booster club treasurer who borrowed $30,000 of the club's money to bankroll a friend's startup. Borrowed, sure, different people, same recipe. Trust plus a gap equals trouble. Why do good people do bad things? Researchers found 3 ingredients show up almost every single time. We call it the fraud triangle. Corner 1, and the most important, is opportunity. A weak system that makes stealing easy and getting caught unlikely. This is the one the company actually controls. Corner 2 is financial pressure. Debt, a surprise medical bill, a lifestyle they can't quite afford. And corner 3 is rationalization, the little story they tell themselves. I'm underpaid. I'll pay it back. They'll never miss it. Here's the key. You can't erase someone's debt, and you can't argue with their excuses, but you can slam the door on opportunity, and that is exactly what internal controls do. Quick gut check before we go on. 3 fast situations. You tell me which corner of the triangle each one is. 1. Nobody ever checks the cash drawer at closing time. 2. An employee is drowning in credit card debt. 3. They keep saying, I deserve a raise they never gave me. Pause here and try it yourself. Ready? Here's the answer. Nobody checking the drawer. That's opportunity. Drowning in debt, that's financial pressure. And I deserve it. That is textbook rationalization. Notice which one the company can actually control. Opportunity. Every time. After a wave of giant accounting scandals in the early 2000s wiped out companies and people's life savings, Congress basically said, enough. They passed a law called Sarbanes-Oxley. Here's what it did, in plain English. First, every public company now has to keep a strong system of internal control, not optional. Second, top executives personally have to attest that those controls actually work, meaning their own signature is on the line. And third, it created a watchdog to police the auditors who check the books. Bottom line, Sarbanes-Oxley made internal control the law, not just a nice thought. So, what is internal control? It's simply the system a company builds to protect its assets and keep its records honest. It stands on 5 building blocks. First, the control environment, the tone at the top. If the boss cuts corners, everyone will. Second, risk assessment, spotting where things could go wrong before they do. Third, control activities, the actual day-to-day procedures that prevent fraud. This is the backbone, and it's where we spend the rest of this video. Fourth, information and communication, getting the right facts to the right people. And fifth, monitoring, checking that the whole system still works and fixing it when it doesn't. 5 blocks, but block 3 is the star of the show. Those control activities come down to 6 principles. Think of them as your 6-piece anti-fraud toolbox. Tool 1, establishment of responsibility. Tool 2, segregation of duties. Tool 3, documentation procedures. Tool 4, physical controls. Tool 5, independent internal verification. And Tool 6, human resource controls. Now don't stress about memorizing these yet, because we are going to open up each tool one by one with a real story of what happens when it goes missing. Let's start with Tool 1. Principle 1, establishment of responsibility. The rule is dead simple. Control works best when exactly one person is responsible for a given task. Picture Maya's Tacos, a little food truck. 2 workers, Anna and Leo, share one cash drawer all shift. At close, the drawer is $20 short. So, who took it? Nobody knows. And that is the whole problem. When everybody is responsible, nobody is. The fix: 1 cashier, 1 drawer, 1 login. Now if it comes up short, you know exactly whose window to knock on. Principle 2, segregation of duties. The golden rule here: the person who handles the money should never be the same person who keeps the records. Meet Sam at Riverside Gym. Sam writes the checks and Sam reconciles the bank statement. See the trap? Sam can cut a check to himself, then quietly cover it up in the very records he controls, and nobody else ever looks. Split those two jobs between two people, and suddenly Sam would need a partner in crime to pull it off, which is a lot harder and a lot scarier. Principle 3. Documentation procedures. Documents are the paper trail that prove a transaction really happened. The big move here, use pre-numbered documents and account for every single number. At Bloom Florist, the sales slips weren't numbered, so a clerk simply didn't write one up, took the customer's cash, and slid it into her pocket. No document, no record, no trace. With pre-numbered slips, a missing number screams for attention. Number 1, number 2, number 4, wait, where's 3? That little gap is your fraud alarm. Principle 4. Physical controls. This is the stuff you can literally touch. Safes and vaults for cash, locked storage for inventory, password logins, alarms, security cameras, even time clocks. At Peak Electronics, the blank check sat in an unlocked drawer, and the passwords were on sticky notes, stuck right to the monitor. That's not a control system, that's an invitation. Lock the checks in a safe, give everyone their own login, and you've closed the easiest door a thief will ever try. Principle 5. Independent internal verification. Fancy name, simple idea. Someone independent double-checks the work, and not the person who did it. At Nova Design, the office manager approved her own expense reports. You can guess how that went. Her wardrobe got a very nice upgrade, and nobody ever compared her expenses to reality. The fix: a separate person reviews the numbers, ideally on a surprise basis, and reports anything strange straight up the chain. Trust, but verify. Especially verify. Principle 6. Human resource controls. This one is about the people. 3 moves. First, bond the employees who handle cash. That's insurance that also screens out risky hires. Second, rotate duties and require people to take vacations. Yes, forcing a vacation is a fraud control because a scheme falls apart the week someone else sits in that chair. Third, run background checks before you hire. At the Lakeside Inn, a front desk clerk never ever took a vacation and ran a quiet discount for cash scam for years. Turns out she'd been fired for fraud at her last job, but nobody checked. A 5-minute phone call would have saved a fortune. Now, real talk. No system of internal control is ever perfect. 4 honest limits. 1. Reasonable assurance. Controls should cost less than the losses they prevent, so companies stop at good enough, not bulletproof. 2. The human element. A tired or careless employee can undo a great control, and a manager can simply override it. 3. And this is the big one, collusion. 2 people working together can beat almost any system because the whole design assumes they're checking each other. And 4. Size. Small companies just have fewer people to spread the duties around, which is exactly why small businesses get hit the hardest. The goal isn't perfection. It's making fraud hard enough that most people never try. Alright, final exam. I'll describe 3 quick frauds. You name the missing control that would have stopped each one. 1. A clerk pockets cash because the sales slips aren't numbered. 2. The same employee writes the checks and reconciles the bank. 3. An office manager approves her own expense reports. Pause here and try it yourself. Here's the answer. Number 1, that's documentation procedures. Pre-number those slips. Number 2, segregation of duties. Split the jobs. Number 3, independent internal verification. Someone else checks. If you got all 3, you're officially thinking like an auditor now. Screenshot time. Here is your 1-card summary. The fraud triangle: opportunity, pressure, rationalization, and the 6 controls that shut the door on opportunity: responsibility, segregation, documentation, physical, verification, and people. Save it, tape it to your wall, bring it to the exam, it's all right here. And that's fraud and internal control. You now know why fraud happens and the 6 tools that stop it. In Part 5, the finale of our cash chapter, we put these controls to work on the one asset thieves love most: cash. Cash coming in, cash going out, and the systems that keep every dollar honest. If internal control finally clicked for you, do me a favor, smash that like button and subscribe so Part 5 lands right in your feed. Free practice exercises and notes are waiting at appliedanalyst.com. No catch, no paywall. I'll see you in the finale.